Good morning, good afternoon, and good evening, everybody. Welcome to this episode. Hopefully are having a wonderful Monday. We just wrapped up our October virtual note buying workshop here the past 3 days, so I'm a little tuckered out, but I wanted to make sure and kind of go through this individual note deal. It's something that we studied on the workshop, pulled it off of a website for you guys, and I think it's a great little case study to show some good returns, some decent returns if you're using other people's money, but kind of the power of taking action more so than anything else, and how some of these little deals do make really good sense to get the ball rocking and rolling. I know we get people that, I try to complicate it. I'm trying to flip big things. I'm really trying to take big. And the whole idea is just keep it simple, stupid. Right? I can't make this any more simpler than it is. And this is a great little performing note. It's in Jackson, Michigan. All right. Jackson, Michigan is on the west side of Michigan. A lot of growth going on in the area, a lot of rehab. It had been depressed for a while, but I really do believe a lot of investors are going in and regentrified. Our buddy Don McAlpin was actually up there a couple weeks ago buying it. Commented on the short 1 minute video we did talking about this deal over the weekend, showing the coaching students how powerful and how fast you can get marketing out to raise private capital. So let's go through this deal. And I'm sure if you have questions, you're going to reach out. I tried to predict the questions you're going to ask. What was funny is I've already had 3 people reach out to me this morning wanting more details of this note from just the 1 minute video that I posted with TikTok and then reshared it to YouTube and then Facebook and then to Twitter and LinkedIn as well. So somebody else liked the video. Good. Somebody asked, do I have paperwork? Good stuff. So let's look at the numbers. Let's look at the specifics about this deal, and we'll get rocking and roll. Now, this is the Jackson, Michigan. It's an older neighborhood. This house is not the newest of houses, but it also is not the ugliest houses. And this is an older photo. It's a couple years old. There's not a new online photo of the property. The other one I found had snow on it. It's Michigan. You're gonna get some snow. And actually, this property does not do the just now. I like the American flag outside. I like emotional equity, but there's a new borrower in the property. The seller of this note of this property on a contract for deed. I sold it to somebody new who basically bought it in months, making payments. So part of it would be your due diligence to drive by. What you can see over the left-hand side is there is a trash dumpster here. I don't know if it's this for this house that we're looking at or the neighbor's house, but there's been some rehab done to it. This photo is taken prior to January of last year. That's when the loan was originated, was January of last year to an owner occupied. So it's right now, it's a performing contract for deed. Now, if you don't know what a contract for deed is, it's definitely something that's very common in Michigan, Ohio. Is basically, these are low balance loans below 100,000. A traditional bank really isn't going to be selling these on terms, but they're holding the deed back in their name, and the deed isn't transferred until the contract is paid off. Now, there is what's nice about this. This is not a 20. I mean, it's amortized over 20 years, but it's got a 5-year balloon for February of 2029. Just under 5 years from us, so 4 2/3 from us. But it's a single family home, 3-bedroom, 1 bath. It originally said 800 square feet online, and I looked at some more stuff. It's 1,100 square feet. So I'd be willing to bet that there's a finished basement in this place. It's kind of common in Jackson. Like I said, it was originally in 1920, but it's been rehabbed relatively recently. The current as is fair market stands around $70,000. Okay, it is owner occupied. We would verify that. But it was purchased for roughly right at $50,000, $49,878 and some change in January 2023. The first mortgage payment took place in February of last year. So they've been making payments roughly about 18 months. Like I said, it's a 20-year note, 10% interest rate. And there's a balloon actually for February 2020, not January 29. My apology. I was typing into it. But anyway, it's still, hey, 4 years from now, you'll be getting paid back whatever the whole balloon is. Now, The current P&I payment, that's principal interest payment, is $537 a month. That's not tax and insurance. There's an escrow of $113 a month on top of that. So the borrower is paying $650 per month, basically. So there's insurance being collected, there's taxes being paid. Current unpaid principal balance is $46,878. So they paid down about $3,000. Right about $3,000. They made roughly right at 20 on-time payments. The spreadsheet was dated as of September 1st. So they were due for September. So we want to make sure that they made September and October payments part of our due diligence. Okay. But we're just going to go ahead and assume that right now. The seller made a notice that they've paid the insurance through July 2025. So that makes me assume that there's forced place insurance that the servicing company is billing the borrower for on a monthly basis, and it's being reimbursed through escrow. Okay. Now the note seller is looking for $32,700 on the note, but they did say they were flexible. So maybe we could even get it at $29,000, $30,000. But it's a $70,000 asset that you're picking up for less than, for basically 46 cents on the dollar, or at roughly about 70 cents on the dollar of UPB, unpaid principal balance. The payoff is right at 46,878 because they're on time. So you're in a pretty good, secure LTV and ITV of the unpaid balance and the fair market value. Not too bad to get started off. And the dollar amount's not huge. We'll talk about cash flow. We'll talk about rent rates here in a minute. So if you just bought this with your own funds, we'll just take it that way first. $537 a month times 12 months is going to be an annual income of $64.44. Let's go ahead and take $25 a month in servicing costs out of it. That's $300 deducted from that. Maybe the servicing cost is covered, maybe it isn't, but we're going to assume it isn't. That leaves you 44 and divide that by 30. Your purchase price of $32,700. That's not any other broker commission fees on top of that. That's roughly an 18.78% cash and cash return per year for you. Now, remember, there's a balloon in 20 months, give or take, provided they keep playing on time. The payoff balance in 5 years of balloon amount should be at $40,756, give or take a couple bucks. That means you would have, if you take what you pay, the difference in that is $8,056 in profit. So you would find when they refinanced out. Now, hopefully, if they're doing the smart thing, they get refinanced out. You get a traditional loan, $70,000 or $50,000, kind of tough to sell. What could you do at that point? Well, could you, if you wanted to keep on the bar to make payments where they didn't pay you off, you could do that. Could you evict and foreclose? Yeah, you could do that too. If they don't refinance, you have all the right to do that. You'd want to double check the collateral file to make sure everything's written and have an attorney review that. But that's a pretty good profit margin. So if we add those things up, the 61.44, we'll just do times 4.3 years, is $26,419 in cash flow. You add an additional $8,056 of the balloon profit. That gives a total of $34,475. Now, $34,475 divided by what you paid for the note at $32,700, that equals 105% return. Obviously, that's over the 4.3 years. So we need to divide that total cash flow divided by the number of years, 4.3. So it comes out to 24.5% ROI altogether if they keep paying and pay off in 5 years. Annually, basically the 18.78, but with a balloon, it's a pretty good ROI at 24.5%. Can we agree to that? You don't just see that every day. Okay. Now, of course, it's the borrower paying on time. Usually the insurance and taxes can need to be paid. There's some things going to happen between now and 5 years. Okay, obviously. All right. But that's kind of a no-brainer. If you like the area, if it's in a good area, obviously, if it's in a shithole, we're not going to buy it. Okay. You send a realtor by or an external BPO agent drop by and it looks like crap, not going to happen. If the collateral file doesn't look good, there's things that will kill this deal before doing it. But the seller is actually selling at a price that kind of makes sense. So hopefully they're in below 32. I think they've had this for a few years based on what I could tell. So they've owner financed this a couple of times, canceled the contract when people stopped paying, took the property back, and then rehabbed it and sold it. So I think that's roughly what I could tell based on the payment history. Because here's the thing, with it being a contract for deed, there's going to be a quit claim deed. That's what's going to transfer ownership from the seller. The deed's in his name. Remember, it's a contract for deed. So basically, it'd be a quit claim deed and assignment of beneficial interest being transferred at the county. And then you would also still have an assignment and an allonge transferred along with your transfer docs to you. Okay. Now, let's say you don't have the 32.7. So you go out and market for investors. Hey, would you like to get 10% return on your money? And say, we're looking for 35,000. Why do you want 35,000? Well, we're going to put a little bit of extra money in our pocket in the front end to help us as a new note investor. Okay. So if you're paying 10% on $35,000, that comes to $3,500 a year. That's $292 a month you're paying your private investor. Okay, now you could start paying them almost immediately if it's a performing note. I would still say do it quarterly just for the heck of it, but that's still not a bad day. So if you take the $537 a month payment that the borrower is currently paying P&I, you minus your $292 monthly payment to your investor. Let's go ahead and take out that servicing charge of $25. That means you're going to net $220 a month in profit to you. Now, are you going to get rich on $220 a month in profit? No, you're not. But guess what? That might pay your cell phone bill. That might pay something. That's a good starting point to get rock and roll, because basically after 12 months, that's $2,640 a year coming in. That's not bad. That's a start. There's a whole lot worse things where you're getting $200. That's still where we want to look at. Okay, that's not bad. That's more than what most people get in rent difference. Okay, but guess what? You're not responsible for the maintenance on this property. The owner is, the borrower is on this. So 220 and not having to do toilet tents and trash outs, hey, that could be a benefit. So after 1 year, you basically got 2,640 coming in. If you figure 4.3 years of profit, that's 11,352 in cash flow to you. Remember, there's a balloon. Okay, so the balloon's going to hit. You're going to get paid off of 40,756, which of course you're going to pay back your private investor 35,000. That's a net profit to you for 5,756 in that balloon profit. Let's go ahead and add that up. So 11,352 plus the balloon payment of 5,756 plus, and I put an asterisk here, $2,300. Now, where did I get that $2,300 for? Well, if you're buying it at 35 and the seller's willing to sell it right now at 32.7, that's that $2,300 difference. It's a little bit of cushion. That cushion's there. I wouldn't go spend it. I would keep that in case the borrower stops paying. You could use that money to handle the eviction. But let's say since they're paid on time, you don't need to tap into that. It's an extra, basically, that's tax-free money right there, $2,300. So all in all, with those three buckets, the monthly cash flow for 4.3 years, the balloon difference between getting paid off and paying your private investor 35, and then what you didn't spend between what you purchased the note at and what you borrowed from your investor, that comes to $19,408 in profit in a 4.3 year period. Not bad. It's about $5,000 a year on average. If you averaged it all out, that's a pretty good deal. Now, let's say you get it for $30,000. Well, then that goes up to $21,000. Because you borrowed a little bit extra. Okay. So that's why I think this is a pretty decent little deal. It's not a get rich quick. It's not a get wealthy. Hey, I take every $20,000 to me. Who wouldn't take that? A little bit per month with a better size payout. So you're going to basically get that 5756. I'm sorry. Yeah. You're basically going to get the 5756 in 5 years. You're basically just getting 2,600 over the 4.3 years. And then let's not get a little bit in the front end, the 2,300, the monthly cash flow, and then a little bit of a bigger payout at the very back end. Now, if the seller, what happens? Okay, what happens if the seller stops paying or doesn't refinance? Well, guess what? In Michigan, a contract for deed is treated as a eviction process. If you're going to foreclose, you're not foreclosing; it's basically going through eviction because they're treated as a tenant relationship. Okay. Now, there is one caveat. If a borrower brings 25% down at the down payment when they purchase the property, then you got to go through the foreclosure process. But Michigan is still relatively a faster foreclosure process. All right. So, hey, not too bad. They didn't bring 25. They bought it for 50, I think they may have put maybe $2,000 down. I want to look at that in the due diligence. How much exactly did they put down? All right. But here's the thing. Think about this. If you put yourselves in this borrower's shoes, they're paying monthly. They paid for almost 2 years straight. The house is worth 70 plus. It's going to appreciate probably $3,000 a year. Do you really think the borrower wants to get foreclosed out on this? No, they're probably going to pay this to the balloon. Okay. And, not so bad. But if they don't, guess what? You evict and now you own the property. It's as it sits now, $70,000 minus your $32,700 purchase price. That's a gross profit of $37,300 as an REO profit if you take back and sold it. Well, there's going to be some closing costs, evictions, and stuff like that going there. So let's just say it's basically, if you take 10% of 70 grand, that's $700, right? Or no, yeah, $700. Okay, so let's say it appreciates $3,000 a year like it has, So next year it's 73, and then following year it's 76 because it is appreciating up there. So we just offset our commission closing costs and you still net about $32,000, provided it doesn't need a complete full rehab. But if it does, guess what? That's where you file an insurance claim through the forced place insurance. Okay. And then you do whatever the hell you want. Turn around and sell it, turn it into a rental because the rent rate's $1,200 per month. Or guess what? You could turn around and owner finance this property on another contract for deed as well if you wanted to. Whatever your decision is, that's completely 100% up to you. Let's see here. So yep, here's the rentometer. Here's a quick pull that we pulled from the address. So you can see the orange dot right here is the property, some green, which is a little low, and then some blue, which is about the same size of comps, and then some red around the area too, where we're talking. So I would say your rent rate is comfortably right at about that 1,200 mark, maybe a little bit higher in some areas. It all depends on the comps associated with it. Okay. But hey, you're going to get probably at least $1,000 a month. Okay. That's not so bad on a $32,000 investment. Any questions, any comments? Now, what would we do our next steps to be? All right. Next steps are, hey, we make the offer and we start the due diligence process. Now, I would make the offer at 30. I would see or 29 to see what they say and then come up, maybe meet in the middle at 31 or 30. They said flexible. Maybe they mean flexible. Maybe they are flexible. But guess what? Is this a deal to lose over $1,000 difference or $2,000 difference? Not really. The numbers make sense as it sits, provided the due diligence comes out. So once our offer is accepted, we would get an external broker price opinion from Baldwin Advisory Group to double check value and external condition of property. We would order a two-owner title report. Definitely on a contract for deed, you definitely want to pull a two-owner report and so get that from Baldwin Advisory Group. We would ask full copies, full scan copies of the full collateral, the financial documents, the whole loan file. We would also ask for servicing notes, an updated payoff from the servicer, payment history, make sure they paid on time. Obviously, making sure that they've paid the last 2 months, the September payment and October payment. Now, if they didn't make those monthly payments and they're behind, whoa, this is now 60 days behind, I would ask for a bigger discount. Okay. I might go back to 25 on this or find out what's going on and seeing what servicing can. Now, if it's self-serviced, I'm not going to be happy with it. I'm going to ask for a bigger discount because self-servicing, there's more information I got to pull and I don't necessarily have a clean track payment history. If somebody just put into an Excel spreadsheet, stuff like that. All right. Like I said, this could be a great deal for your self-directed IRA, some lazy assets, or raising private capital. I mean, listen, folks, 10% is a pretty damn good return for someone to be passive for 4 years, right? 5 years. Hey, that's not a bad day to get things rocking along. Question here from somebody. Dale says, nope, good question. Good info on the balloon. Don't think we covered that yesterday. On self-service, I tell the silver that's coming right off the top of any offer. Yeah, exactly. No, we didn't discuss the balloon yesterday. I mean, we talked about if they refinanced in 60 months to compare what we borrowed the note for, and then we ran by the amortization table. But when I was looking, doing a little bit deeper dive, there's a balloon on it. And you cannot, and yes, it's still legal for people to put balloons on contract for deeds if they're not doing it like a traditional mortgage company and doing, more than really 4 a year. Okay. Yeah. if it's self-serviced, I'm going to be like, listen, we're going to deduct, we're going to take the cost for self-servicing and a little bit more to put that damn thing together because it's going to be a pain in the ass to get the servicer to deduct. We're going to want every canceled check, a proof of every payment made and handled through the servicing companies that handle individually. All right. And why is the borrower not paying it? All right. So, any other questions, comments, concerns from you guys? Not a bad little deal to get started with. Can we hear that question here from somebody? Did the listing show in escrow? Yeah, they're paying the $116 roughly dollars per month. I'll go back to the first. So yes, they are paying $113 a month in escrow payments. So they're paying insurance and taxes. I would be one. So they're paying taxes, at least the insurance is being paid in full per year, and they're getting renewed back from it. Because basically they're paying $113 a month. That's $1,300 a year coming in escrow. I don't think the taxes on this are $1,300, but I have to go take a look at it because I can't remember. But anyway, there you go. All right. Questions here. Thank you, Dale, for asking. Escrow is a good sign. I agree it's a good sign. It definitely is a good sign that it's probably being serviced with somebody else, which I like. So, all right. If there's no other questions, I want to thank you guys that are jumping on here that were part of the workshop the last couple of days. Great to see you guys. We'll have the replays available to you probably by Wednesday. I'm not going to do too much work the rest of the day to recover from teaching all weekend. But as always, feel free to book a call with me at talkwithscottcarson.com. And if you're listening to this episode or watching the video and you'd like to see about getting into deals like that, feel free to reach out to me, talkwithscottcarson.com. We'll talk about your goals, expectations, what you're looking for, and see if we can't make it a win-win scenario out there for you. So, any other comments? Awesome. We'll go. Enjoy your Monday, ladies and gentlemen. Go have a good day. Make it a productive week. Thank you, as always, for listening. Thank you for watching. Make sure you leave a 5-star review and subscribe to either the podcast or the YouTube channel, and take some action. And we'll see you at the top, everybody. Bye. Thanks, Dale. Thanks, SK. Thanks for jumping on. Appreciate it. Y'all have